Welcome, everyone. My name is Brendan McCarty. I am the CIO and founder of Column E, and thank you for joining us in our inaugural video concerning one of our blog posts that we put out from time to time called Chart Views. Chart Views typically focuses on sectors. Today, we're delving deeper. We're going into the S&P 500 as we considered it the most important index in the equity markets globally and, well, within the U.S., of course. Thanks again for joining us. Before we proceed, just a quick reminder, you can find more information on us at columne.com on our blog Between the Columns. There's also information in regards to the firm. We are a limited liability commodity pool operator based out of Delaware, and we currently manage the Harbinger LR fund along with the 3L strategies and our new creation, the 3LW. So without much to do, let's proceed and advance to this week's discussion on the S&P 500. So as we just mentioned, the S&P 500 is the most important index that we follow, is the one we trade primarily in the Harbinger LR fund. And it is currently had an amazing run in 2023 and continues to move higher, though the NASDAQ is a little bit stronger, each driven by a very narrow move. So for the S&P this week, we're going to look at 5 variables. These 5 variables to us are the fundamentals, if you will, of the macro picture for the S&P 500. They include price direction and trend, simple technical analysis and momentum, breadth and momentum, which is a combination model, which we will discuss, earnings sentiment. It's another model that we use, not absolute, little bit different. Risk, the key variable driving everything right now, and finally liquidity and demand, which is a mix that is just not favorable right now to the bulls. So let's start with the price and trend. Simple technical analysis, though this chart is far from technical. These lines are drawn from an algorithmic model that we use behind the scenes, plenty of math, plenty of lining up the lines, if you will. The more clustered a set of lines is, the more support there is for a given market. The S&P 500 has been climbing steadily for much of 2023. I believe the 4-week period during the collapse of SVB and others is the only time the S&P has been down within our short-term range models, which you can read about during our rundown piece every Monday. The S&P, as you can see, broke recently through 4,300 at the end of June. And is pushed higher in July with a tremendous week this week. 4,700 is roughly where it's heading. But interestingly enough, we're coming full circle on momentum. So during the collapse last fall, momentum hit negative minus 20%, similar to the lows in 2020 and also the lows in 2018, late, when everybody was surprised by the lack of a Christmas rally. This is significant in that we just boomeranged, if you will, from very oversold to almost very overbought. Momentum bottle at last measure was over 110% from a minus 20. So if we would have hit 120, I guess that would be symmetry. But this extreme level of the market is quite elevated. It does occur from time to time because markets just get excited on breakouts, and this is what this is. So from a price and momentum standpoint, the S&P is chugging. It's very strong. But how sustainable is that is the question. The CE breadth and momentum model is a combination of that 110% we just mentioned, plus an element of breadth. Breadth, for the most part, has gone sideways since last fall. Incidentally, that's when liquidity bottomed. So if the market wasn't so narrow over the past 9 months, 10 months now, we may not see the S&P at 4,500 and change, but rather 4,000. I'll let you do the math in terms of where it should be. But breadth and momentum has been generally rising. You can see from the March lows. If you go back to September, it's higher from there as well. So the combination of breadth and momentum has been supportive for higher stock prices. As high as they are today, that is ultimately the question. But what notably of this model is on June 14th, this model peaked when the S&P was at 4,400. This model is still below that level, and the S&P is now 4,500. Please, this is a negative divergence in straight technical analysis terms. It's also a negative in terms of sentiment. The next piece is the earnings sentiment model. Now, we're not the biggest fans always of sentiment, but this model is very important. It shows turns in sentiment. It's basically a measure of the direction of earnings relative to the surprise that we see going forward. The more surprise, the more that sentiment has to catch up. Earnings analysts have to catch up. Market strategists have to catch up. This can go up or this can go down. We noticed in 21, late in 21, this turned lower. Markets collapsed during Thanksgiving, if you remember. This turned higher in late July this time around. Markets turned up in October. So it has a leading function to it. It's more of a believing, seeing as believing, if you will, before the market is willing to go higher. We will note, however, that the short-term model right now is not higher than it was at the turn in August. The gap is still wider versus the long-term model. That largely is what matters, but there is some weakness to this as well. This is our risk model. This is the most powerful model, if you will, driving the S&P and the equity markets right now. Since the turn last year, the S&P has risen significantly, breaking through 4,000 and then exploding once it got over the 65-week. It has continued to climb, making new highs, and recently got over 4,500. Where this risk index is hitting the upper band right now and is extending at its greatest rate, probably off the 19 lows, strangely enough. Even though 19 wasn't much of a market, that market actually went sideways till the fall, when then we took off, and then we know what happened in 2020. But right now, risk is rising, and that is driving the markets higher. If you add in liquidity from the injections in March, you get quite a potent mix. Higher risk, more cash to invest, higher risk assets. This is our liquidity model just mentioned, and also demand at the bottom. As liquidity rises, the S&P 500 has risen. You can see that from left to right. It peaked in 21 when the Thanksgiving sell-off began. It fell through 22. S&P 500 fell. NASDAQ fell even harder. It flatlined in October, and it sort of kept going that till SVB failed. The Fed injected another $300 billion in securities. That multiplied the model up. S&P took off thanks to the rising risk from the previous chart, and now we have the widest gap between the two in some time. Not shown on this chart is the lead up to the to 2020. The gap was quite wide, and it led to a very significant correction in risk, correction in the S&P. We might be setting up for that, though that is a tough thing to gauge. We'll just say right now that the market is rising away from liquidity, and it's doing so with limited demand on the earnings side, as shown at the bottom of the chart. So the bottom line for the S&P and for this market, and missing chart here, is this. The S&P is rallying, the price is rising, and momentum is climbing, but the variables underneath are waning. If earnings demand were to turn up, that would replace the waning liquidity figure. If liquidity turns down, and it is falling a little bit, it hasn't made a lower low for May yet, as of yet, but if it were to turn below May's low and demand does not rally, that's negative to the corporate balance sheet, as liquidity dries up, if you will, which creates less in the overall market, which creates less lending and capital availability. Risk, as long as it continues to rise, will offset these two, it appears, for the time being. But there is a limit to how far risk can go, as we've all seen over the years. Is this market similar to the bubble in 2000? Who knows? We've seen very similarities to 2003 and 2009. We don't see 2000 as of now, anyway. So thank you again for joining us. Please read this important disclaimer, of course. And if you want to learn more about Colony, visit us at colony.com. My name is Brendan McCarty. I thank you for joining us for this presentation, and have a wonderful week.